Hey, Kevin here, top 1 financial advisor and best-selling author, and we are here to talk about the stock market. Today, I want to tell you how to invest your 401k and give you some tips and tricks and strategies you can use to open it, to invest in it, and to contribute to it on a regular basis. So, it was a question that was asked via Instagram, and like I always say, when y'all ask good questions, I get to come out with great videos. My day job is to answer your questions. Basically, if you come up with great questions, I sit down and say, okay, well, how can I put this into a YouTube video? How can I put this into a TikTok? Whatever it is. You ask, I answer. That's how this works. Now, I know a lot of y'all are asking questions on specific companies. We're getting to those. Just need a little bit more time, like over the weekend, to like dig through all the things I want to dig through, so I can come up with great quality content as opposed to just throwing stuff at you. All right. So this question comes from Tiffany about Roth IRAs. Hey, I watched your video on YouTube regarding Roth IRAs and 401ks. Subscribe. Go on and hit that button now. This is the benefit of doing that. So she watched the video. She did her homework. All right. So I already have the 401k set up. Perfect. I plan to open a Roth IRA for myself soon, and wondering if you can make a video on how to invest the money that I contribute on a monthly basis with S&P 500 index funds. Thank you so much. Prayer hand emojis. All right. There we go. Some people say the prayer hand emoji is like 2 high fives. I don't know. It's a question I have, but I don't know. But let's go ahead and get into it. So I'll start with what a Roth IRA is, what are some strategies you can use, and then how you can invest on a monthly basis. All right, so number 1, Roth IRA is an investing account. It stands for Individual Retirement Account. The Roth IRA was started in 1998, and as of 2022, and again, these do change every now and then, which is why I put 2022 in the title. As of 2022, if you are under the age of 50, you can put up to $6,000 into your Roth every single year. When you turn 50, you can, or 50 and above rather, you can put in $7,000 per year. Again, these do change every now and then based on the IRS. There is an income limit, so if you make too much money, congratulations to you, but if you make too much money, then you cannot contribute to a Roth. These numbers also change, and I'm doing these from memory, so if I'm off by a few dollars or so, please forgive me. If you are a single income, so you file your taxes by yourself, you're not married at all, it's right around $144,000. It's a weird number. If you are close to that number, check with your accountant, check with Fidelity, which is where I have my Roth IRA, and I'll talk about a little bit about that. Check with them, say, look, this is what I make. I talk to my accountant. Do I qualify for a Roth IRA or not? For married filing jointly, it's like $200 and some thousand or so. And again, the numbers are weird, but go back, check with your accountant. Your accountant knows, because they stay on top of those numbers every single year. And if you are married filing separately, I don't know what you're doing, but the limit there is like $10,000. Okay, so not the limits you can put in, we're talking about like the income limit. You make more than $10,000, that's it. No Roth IRA for you if you're married filing jointly. All right, so those are the tax brackets. So if you make too much, no Roth for you, unfortunately. But if you fall within those income ranges or you make less, then Roth IRA is for you. What is it and why is it really cool? The best thing about a Roth is you can contribute that money, invest that money, and when you are ready, after 59 and a half, keyword, after 59 and a half, you can use all of that money and pay $0 in income tax and $0 in penalty. At any point in time, which is great, if I put in $6,000, I put in $2,000, I can pull out that $2,000 and use it right now today with no tax and no penalty, because I've already paid taxes on it. This is a post-tax account, meaning I paid my taxes, I got my gross pay, I got my net pay, I took that net pay, I put it inside a Roth IRA, I took that money and invested in Microsoft or Tesla, whatever stock you want to invest in, and it grows. Okay, so that is the benefit from it. For it, rather, I'm 59 and a half, I take all that stuff out, I pay no taxes. That is a great benefit. Here's the other thing that you need to know. Remember, there's a difference between the money I put in and the money it grows to. For example, if I put in $6,000 and it grows to 10, how much money do I get to take out right now at age 32? The correct answer is, let you do some math here, the correct answer is $6,000. I put in $6,000, I take out $6,000. The $4,000 that it grew to, I can't touch that until 59 and a half. Okay, now just because you can withdraw the money doesn't mean you should. That's a conversation for another day, but I want to have that money compounding literally as much as possible. Okay, so now that you know what a Roth IRA is, now that you know how it works on a very high level, where can you get one? You can usually get these at some of the more established players in the investment game. So we're talking Charles Schwab, Fidelity. I guess if you want to go to like a Morgan Stanley or something like that, Merrill Lynch, I guess you could. My favorite is Fidelity. That's just where I go. That's where a lot of my students go. TD Ameritrade is another place. A lot of the newer apps like a Robinhood or a Public or any of these apps that are popping up right now, they don't always have an option for Roth IRA. That's like on their pathway. That's the thing they want to do, but as of right now, they don't offer those options. So I like to stick with some of those bigger legacy players like Fidelity or Charles Schwab, stuff like that. That's where most people have like their retirement money, their IRAs, especially their Roth IRAs. So that's where I would go to open one. Super simple. I actually taught students last year as a part of the project with the Plutus Foundation how to do this. It took us like 10 minutes. You put in your name, birthday, all your information, connect your bank account, boom, Roth IRA set. You're good. Before I kind of get more into like the how to invest part of it, because I know these questions pop up all the time. Yes, you can have a Roth IRA for your child. It would be one of the best assets that you could get. However, two things you need to know. Number one, they need to have a legitimate job, earned income. So allowance doesn't really count. I can't just funnel money to my kids, have them have a Roth IRA and call it income and then have them be super rich. Wish that were the case. That ain't exactly legal in terms, tax wise. That's number one. Number two, you do want to check with your accountant because that may or may not impact their financial aid in the future if they decide to go to college. That's again another conversation for another day, if I care about that situation or not, but it is something that you may want to consider if you have kids, if you want to have a Roth IRA. If your kids are, let's say, 16, they work at, 7-Eleven or Sheetz or Wawa or Buc-ee's or Quick Trip, trying to name as many regions as I can because y'all know people love their gas stations, then I would absolutely have a Roth IRA, which I did when I was 16 and working there. Life could have been a bit different had I known how to invest back then. All right, now, how to invest question. We got all the major questions that people usually ask out the way. Now, how do you invest it? There are a few primary ways that you can do this, especially if you're using index funds. One way to do this is what's called the rule of 110. And what that is, you take the number 110 minus your current age. That's going to give you how much you should be investing in, let's say, equity index funds, like stock market index funds, something like SPY or VOO. Those are two index funds I like for the S&P 500. You pick which one you want. The differences are really, really small. We talked about that before. So that means that if I'm 30, right, I take 110 minus 30, that's going to leave me with 80. That's 80% of my money I should be putting into one of those index funds if I want to make something super, super simple. So that means that, let's say I'm putting in $100 every single month, $80 every month I'm putting into that ETF. Well, what happens to the other 20%? That is where a bond fund is going to come in, something like ticker symbol BND. This is a super simple, really, 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 really simple portfolio. You might want a few more ETFs. You might want an international fund and some other stuff. But again, super boiled down. You can absolutely get away with having, VOO and BND and that be your entire portfolio inside your Roth IRA. You could do that and be relatively covered. And if I'm putting in $100 every month, $100 to VOO, $80 to VOO, $20 to BND, and just do that back and forth, back and forth, back and forth. And, when I turn, 31, 32, I can adjust these a little bit. I would probably, honestly, in real life, I'd probably keep it the same until I'm 35 and then adjust it down just a bit and continue doing that. You could absolutely do that. That's the easiest back of the envelope way. Is it the most precise way? Is it the most scientific way? Probably not, but it does get the job done. Now, the second way and more precise way, so if you were a client of mine and we sat down and we're trying to figure out how to invest your money, we're going to do what's called a risk tolerance questionnaire. You can Google this and type in risk tolerance questionnaire Vanguard and it'll pull up a website and you'll answer a few questions. based on the answers to those questions, it will spit out a number and tell you that 50% of your money should be here, the other 50% of your money should be there. Again, you take the same $100 or whatever money you were going to invest anyway and divide that percentage into the investments that you are looking at. That is another way that you can do it. That's the more precise way, and you should retake that quiz, retake that questionnaire at least once a year. Twice a year, quarterly is the absolute most that you want to do it, but I think once a year is fine. You don't feel too much different, right? And when you take those types of questionnaires, because the world doesn't move that fast for that type of questionnaire. So those are two ways that you can figure out how to invest. In terms of asset allocation, that's the technical term for it. Okay, so I can do the rule of 110, or I can do the risk tolerance questionnaire. If I'm putting in $100, $500, whatever it is, I'm going to split my money into whatever those percentages tell me to put it into. Every year, come back, refresh those numbers. My own personal money right now, I'm about 85% in stocks, about 15% in cash and bonds. That's what I feel. Okay. Now there are advantages. The more you have in stocks, usually the higher growth rate you're going to get. You're going to make more money. You usually make more money. However, when the market hits these hiccups like it did today and yesterday, you tend to lose more money because you have no cushion, you have no cash, you have no bonds to kind of balance you out and make things smoother when the market is choppy. But when the market is up, I think it was up 27% last year, those who are really heavy into stocks made a whole bunch of money. So it's going to be a not a catch 22, but it's going to be a balance. You have to find out what balance makes sense for you at the point that you are in life. Why do I say that? Because in 2008, you had people that had 85, 90% of their money in stocks. 2008 happened and boom, guess who's working an extra 7 years for the market to come back and recover? Not the place that you want to be, which is why the older you get, usually the less risk tolerance you have. So right now, in my 30s, I can have 80, 85% of my money in stocks, and I can be calm when the market falls. Now, when I'm 60 or when I'm 55, I might not want to do that. I might want to be closer to, 60, 40, 50, 50 or something like that, so that market falls, hey, it was only half of my money that was in the stock market anyway. The rest were in bonds. I didn't lose that much. I'm going to be better off. Some people, like my kids, who are 3 years and 1 year old, there's 100% in stocks. I don't care. They're gonna be fine. They can do this for 18 years and still have a long way to go because they can take on that amount of risk. So you always want to sit there and figure out what that balance is. You can do that balance with the rule of 110, or you can do that figure out that balance with a risk tolerance questionnaire. Okay, so what is the next thing that you might want to consider? So number one, you can absolutely do all index funds and leave it alone. I'm totally fine with that. You can also, if you are someone who is more aggressive and you want to invest in individual stocks and you are investing in good quality companies that tend to grow pretty well, this is the perfect place for a Roth IRA. For example, I have Tesla. I wasn't gonna log into my account, it's gonna take me too long. But for example, I have Tesla, and a good chunk of my Roth IRA is in Tesla, which means that if I hold on to Tesla and Tesla continues to do what it has been doing, you can argue that may not be possible for another 20 years until I'm in my 50s. But let's say it did, then I get to pull all that money out tax free. Boy, that's where you want to be. So, a lot of my big growth companies, the Nvidias, the Microsofts, to a lesser degree, the Googles, definitely my Tesla, I have that kind of stuff. The things I know have had a long history of strong growth, I'm putting that inside my Roth IRA so that when I'm ready to pull it out, I'm paying no taxes there. So that's a little bit of a strategy piece. But if you have something that is aggressive and has grown well and has a good track history, that's where I like to put it, because I can pay no taxes on it. Now, there's no disadvantage per se by having it on my public account where I would pay taxes when I sell it, because I can use that money now for one, right? Whereas the Roth IRA, I really just want to leave that alone and let it grow. But some people like to say, look, all my aggressive stuff, I'm going to slide in my Roth IRA, I'm going to depend on it, I'm going to let it go for the long term, and we're going to be good there. Okay? All right, so that is it. That is it for Roth IRAs. You know where to get one, Fidelity, Charles Schwab, places like that. You know how to invest on a monthly basis. You can use a rule of 110 or you can use a risk tolerance questionnaire. Both of those work. One is better, one is more precise rather. One is more precise than the other. It's going to give you a more realistic answer for where you want to be. You know about the index funds that I talk about. You know, VOO, because we talked about the S&P 500. The question was S&P 500. SPY or VOO, either one of those work for the stock side of things. B and D is always my go-to for the bond side of things if you want to stay index fund altogether. If you have quality stocks that are known to grow quite well, you might want to consider putting that in the Roth as well. All right, so that's it for me. I'll talk to you guys later. If you have any other questions about Roth IRAs or just investing in general, feel free to put that in the comments below. All right, talk to you guys later. Bye.